My name is Adam Remis, CPA. I've been a CPA for nearly 27 years, and I absolutely love helping my clients save money on income taxes. But first, what I'd like to do is talk about a couple of very specific acts that have affected and changed the world of tax planning. The first is Secure Act 2.0. It was actually signed into law in 2022, the very end of 2022. And it changed so much when it came in to tax planning and income taxes for businesses. It changed what we do from a retirement plan perspective, what we do from a income tax perspective for businesses, and more importantly, what we look at over the next 3 to 4 years for our clients, because the impact was absolutely massive. The second item is what they call TCJA. It's the Tax Cuts and Jobs Act. That actually occurred about 4 or 5 years ago, but once again, it had a significant impact into retirement planning, as well as what businesses can do and should do off their different types of organizations, whether they're an S Corp, C Corp, partnership, or even just a Schedule C sole proprietorship. Hello everyone, my name is Adam Remis, CPA. Today we're going to talk about family and education credits. This is an area that we work very closely with our clients on because there's so many different changes that have occurred, not only under TCJA, but the Secure Act, but it seems like every single year there's more and more different things that happen, whether it's credits or deductions or the kiddie tax. We just need to be on top of it. That's our job, to be on top of it. But it's also our job to communicate effectively depending upon each circumstance that our client presents to us. Today, we're going to cover a bunch of items, from the child and dependent credit to the care-related breaks, the kiddie tax, my favorite, the 529 plans to pay for collegiate expenses, student loan breaks, the ABLE accounts, educational credits, the American Opportunity Credit and the Lifetime Learning Credit, as well as ESAs. First topic that we want to cover is something that's bread and butter, that's used all the time by just about everybody, and it's the child and dependent and adoption credits. If you adopt a child, please consult your CPA. I know that's probably the last thing you'd think of, but please consult your CPA. There's so many different rules and regulations, whether it's a domestic versus international adoption, and the timing of when you actually formalize the adoption is critical from a tax perspective. A lot of times you don't have control over when the adoption actually occurs. I get that, but if you have choices, these are the things that we would want to keep in mind when we think about adoption and the specific adoption credits. The child and dependent credits, remember, for each child under age 17, at the end of each tax year, you may be able to claim up to a $2,000 credit. Remember, credits are different than deductions. Credit decreases your tax liability. Deduction is off of income that then takes a tax hit. In other words, anywhere from 10 to 45%, and that's the tax you actually pay. For each qualifying dependent, other than a qualifying child, you may also be able to claim a $500 family credit. So each year changes things, but these are the types of credits that you want to think about. Care-related breaks. These are specific tax credits. Please work with your employer. There's the Child and Dependent Care Tax Credit and the Child and Dependent Care FSA. Why I said work with your employer? Many times, these are provided by your employer, especially the FSA. The FSA is a flexible spending account. You can contribute all the way up to $5,000 pre-tax, and that money can be used for dependent care for your kiddos. The Child and Dependent Care Tax Credit, that's for children under 13, and the maximum credit is $600 for one child or $1,200 for 2 or more children. Kiddie tax. The kiddie tax is not a credit, it's not a deduction. It's a tax. It's something that you really want to avoid. The kiddie tax generally applies to unearned income beyond $2,500 for 2023 for children under age 19 and of full-time students under the age of 24. That income, after you get to a certain height on the children's tax return, is then treated as parental income from a tax perspective and is at the parent tax rate. It's something definitely to avoid from a tax planning perspective. 529 plans. I love 529 plans. If you've not heard of this, you need to dig in. It's a tax savings plan that allows for you to save money for college education expenses for your kiddos. You can choose a prepaid tuition plan to secure current tuition rates or a tax advantage savings plan to fund educational expenses. Although contributions aren't deductible, their growth, investment purposes perspective, is tax deferred. That is very important. You can also use it for elementary and secondary school tuition, up to $10,000 per year per student, and also up to $10,000 of student loan debt per beneficiary. There's just a lot of uses and things that you can do with 529 plans. Keep in mind, every state has its own plan, and you need to look at this carefully from a CPA planning and tax perspective. The next topic I'd like to talk about is student loan breaks. Regarding forgiveness of this debt that is in the news, this is the debt that individuals have after they've graduated college. It's college debt. Please remember, while a lot has been forgiven at the federal level, it doesn't necessarily mean at the state level it's not income. So just to clarify and kind of walk back a little bit, President Biden on February 22nd, 2024, announced another $1.2 billion of student loan debt forgiveness, which actually brings the total north of $138 billion of cancellation student debt that's occurred over the last several years. This affects not just hundreds of students, but thousands of individuals who can qualify. Remember, President Biden is at the federal level. He's not at the state level. Many states are following the lead and going ahead and doing forgiveness of student loan debt, but not every state. I think California is one of the states that's different, and we can list out one after another, but you need to carefully evaluate what your state income tax effects are going to be when you're doing and accepting the student loan forgiveness debt. ABLE accounts. ABLE accounts is considered, and I don't know if everyone understands what an ABLE account is, but ABLE stands for Achieving a Better Life Experience. ABLE accounts offer a tax-advantaged way to fund qualified disability expenses for a beneficiary who became blind or disabled before age 26. Under TCJA, through 2025, 529 plans funds can be rolled over into ABLE accounts and then be used on an ongoing basis to care for the beneficiary of a trust or that plan to fund any qualified disability expenses. It's something to keep in mind if you have a kiddo that is in that circumstance. The next topic I'd like to talk about is education credits. Education credits has been around forever and ever and ever. The two that you may be familiar with that has not changed is the American Opportunity Credit and the lifelong or lifetime learning credit. The American Opportunity Credit is a credit and a tax break that covers 100% of the first $2,000 of tuition and related expenses and 25% of the next $2,000 worth of expenses. The maximum credit per student is $2,500 per year for the first 4 years of post-secondary education. The lifetime learning credit is something that if you're paying for post-secondary education expenses beyond the first 4 years, you may benefit from the lifetime learning credit. It's up to $2,000 per tax return, and many people qualify for this, but they just don't realize. So we'd have to dig in for each client and understand whether this credit is applicable for you. The last item I'd like to talk about is ESAs. ESAs are educational savings accounts, otherwise known as Corvdell Education Savings Accounts. These are very similar to the 529 savings plans in that contributions are not deductible on the front end for tax purposes. But the plan assets also can grow tax deferred, and distributions used to pay for qualified expenses are income tax free. ESAs are worth considering. You really should investigate having an ESA and potentially even a 529 plan. If you'd like to get more information, talk to your CPA or us. We can give you plenty of information about ESAs. This is Adam Remis, CPA. Once again, I hope you enjoyed this conversation. Thank you very much for your time, and I look forward to spending more time with you in our next webinar. Thank you.